What if I told you that starting from 2026, the Australian government has made changes to the pension system that could directly affect the money in your pocket every single fortnight? And what if most people don't even know about these changes yet? If you are a retiree, if you are planning for retirement, or if you have a parent or grandparent receiving the age pension, then the next few minutes could be the most important thing you watch this week. Stay with me, because what I am about to share with you is something that affects every single Australian, and missing this information could cost you thousands of dollars. Welcome back to Aus Pension Update, the channel that keeps you informed, keeps you updated, and makes sure you never miss a single change that affects your retirement income. I am so glad you are here today, because this is one of those videos that I really feel every Australian needs to see. If you are new to the channel, make sure you hit that subscribe button and turn on the bell notification, because at Aus Pension Update, we cover every single update, rule change, and government announcement that affects the age pension, Centrelink payments, and retirement benefits in Australia. And today, we have a big one, so let us get straight into it. The Australian government has rolled out a series of significant updates to the pension system in 2026, and these changes are not small adjustments. They are structural shifts that are going to affect how much money you receive, how your assets are assessed, and what rules you must follow to remain eligible. Let us start with the first major change, the pension rate increase. As of March 2026, the age pension rates have been officially updated. For a single person, the maximum fortnightly payment has increased. For couples combined, there has also been an upward adjustment. Now, these increases happen twice a year in Australia, in March and in September, and they are tied to the higher of the Consumer Price Index, the Pensioner and Beneficiary Living Cost Index, or the Male Total Average Weekly Earnings Benchmark. So the government does try to keep pace with the rising cost of living. However, and this is where it gets very important, these increases do not automatically mean you will receive more money, because the income test and the assets test are also being adjusted at the same time. Now let us talk about the assets test changes, because this is where a lot of people get caught off guard. The assets test thresholds have been updated as of January 2026. This means the amount of assets you are allowed to own before your pension starts to reduce has changed. For homeowners who are single, the lower assets test threshold has gone up. For non-homeowners who are single, the threshold is higher. The same applies to couples. What this means in practice is that if you are right on the edge of the assets test, if your assets were just over the limit last year, you may now find that you qualify for a part pension that you did not qualify for before. This is actually good news for many Australians who thought they had been locked out of the pension system. But here's the flip side. The assets test taper rate, that is, the rate at which your pension reduces as your assets increase, remains at $3 for every $1,000 of assets above the lower threshold. This has not changed. So while the thresholds have gone up, the taper is still there, and it still bites. If you have recently inherited money, sold a property, or received a lump sum of any kind, you need to report this to Centrelink immediately, because failing to update your asset information can result in overpayment and subsequent debt recovery. And that is a situation you really do not want to be in. The second major change in 2026 is around the income test and the work bonus. The work bonus, which allows pensioners who do part-time or casual work to earn some income without it affecting their pension, has been permanently extended following a temporary expansion during the cost of living crisis. The work bonus balance has been locked in at a higher level, meaning pensioners can now earn more through employment before the income test kicks in. This is a significant change for those of you who want to stay in the workforce, even part-time, without losing your pension entitlements. It gives you more flexibility, more financial breathing room, and more freedom to top up your income through work. The third major development involves superannuation and its interaction with the pension. From 2026, the rules around how your superannuation account balance is assessed when you reach pension age have been clarified following a period of policy debate. If you are under pension age and your super is still in the accumulation phase, it is not counted in the assets test. However, the moment you reach pension age, your super balance, whether in accumulation or pension phase, becomes accessible. This is a critical point that many Australians miss. If you are approaching pension age and you have a large superannuation balance, you need to plan carefully because the timing of when you draw down from super and how you structure your withdrawals can significantly affect your age pension entitlements. The fourth area of change is around gifting rules. The gifting rules under Centrelink are very strict, and in 2026, the government has reaffirmed its commitment to enforcing them. You are allowed to gift $10,000 per financial year and a maximum of $30,000 over a 5-year rolling period. Anything above these limits is treated as a deprived asset and is still counted in your assets test for 5 years after the gift is made. So, if you are thinking about giving money to your children or grandchildren as a way to reduce your assessable assets and increase your pension, please understand that Centrelink has very clear rules about this, and they will investigate if they suspect deliberate asset reduction. The fifth update relates to rent assistance and housing costs. With rental prices remaining extremely high across Australian cities and regional areas, rent assistance for pensioners has also been updated in 2026. The maximum rent assistance payment has increased, which provides some relief to the thousands of Australians who are renting in retirement. If you are a pensioner who rents privately and you are not receiving rent assistance, or if you are not receiving the maximum rate, you should absolutely contact Centrelink and review your eligibility, because this extra payment can make a real difference to your weekly budget. Now, the sixth point I want to raise is about deeming rates. Deeming rates are the rates that Centrelink uses to estimate the income your financial assets are earning, regardless of what they are actually earning. These rates have been a point of significant controversy in recent years, particularly when interest rates rose sharply, and many pensioners felt the deeming rates did not reflect the real returns on their savings accounts and term deposits. As of 2026, there has been an update to the deeming rates, and it is essential that you check the current rates and understand how they apply to your situation. If you have a large amount in savings or investments, the deeming rate directly affects your income test calculation, and even a small change in the deeming rate can change how much pension you receive. And finally, the seventh and perhaps most important update for 2026 is about the digital reporting requirements through Centrelink and MyGov. The Australian government has continued to push for greater digital integration, and there are now stricter expectations around how and when you report changes in your income and assets. Missing a reporting deadline or failing to update your information when something changes, such as a change in your bank balance, an investment sold, a property purchased, or even a change in your living arrangements, can result in payment suspension or debt recovery. If you are not confident using MyGov or the Centrelink app, I strongly encourage you to reach out to a financial information service, visit your local Centrelink service center, or call the Centrelink Age Pension Line for assistance. Copy. So there you have it. 7 major updates to the Australian pension system in 2026 that you absolutely need to know about. From the rate increases and asset test threshold changes, to the work bonus expansion, superannuation rules, gifting limits, rent assistance, deeming rate updates, and digital reporting requirements, there is a lot happening, and staying informed is the best thing you can do to protect your income and your retirement security. Here at Aus Pension Update, our mission is simple: to make sure that you always have the information you need when you need it. We want every Australian retiree and every person planning for retirement to feel confident and in control of their financial future. So if you found this video helpful, please give it a thumbs up. It really does help the channel reach more Australians who need this information. Share this video with a friend, a family member, or anyone you know who is on the pension or approaching retirement age. And if you have not already, subscribe to Aus Pension Update and hit the bell so you never miss an update. If you have questions about any of the changes I covered today, drop them in the comments below. I read every single comment, and I will do my best to help. And remember, when in doubt, always contact Centrelink or speak to a qualified financial advisor to get advice that is specific to your personal situation. Thank you so much for watching. This is Aus Pension Update, and I will see you in the next video.